our Understanding Retirement Plan Fees webinar. We have a couple of housekeeping things as our last-minute joiners join us. First, before Brian gets started, just wanted to remind everybody that we've got you on mute, just so that we can reduce any background noise. So if you do have any questions, please use the question widget with GoToWebinar, and we will address the questions as they come in. Also, we will have a recording of this presentation. As you can see probably from your GoToWebinar, we are recording the session, and once we get through today, you'll be getting a follow-up email with a link to the recording as well as the slides. So let's give any last-minute joiners just a minute or two, and then I will kick it over to Brian, and he can get going. Thank you. All right, well, we have 2 past the hour, so let's go ahead and get started. Thanks again for joining Multnomah Group for Understanding Retirement Plan Fees. Our presenter today is Brian Montanez. So, Brian, take it away.
Good afternoon, everybody. Thank you for joining us here today. As Lindsay mentioned, my name is Brian Montanez. I am a principal with Multnomah Group and an investment advisor and retirement plan consultant. Been doing this type of work about 20 years now. So today, I want to arm you and inform you to be able to address all the different types of fees that you're going to find in your retirement plans. One of my childhood friends is fond of saying, nothing in life is free. If you want nothing, have as much of it as you like. And unfortunately, we hear that in the retirement industry a lot, which is, oh, there's no charges to you. Well, there's always charges. People don't do things for free, and this is a service. So today, I want to walk you through all the different types of fees that you're going to find in a retirement plan, so that should you be reviewing a 408b2 and not quite sure what that one line item is about, or should somebody say, oh, we don't charge you, you'll be forearmed. So today I want to talk about why understanding fees is important, and we're going to throw a little a little Latin in here today. Fiduciary obligations regarding fees, and then I'm going to go through in minutia, actually, a review of common plan fees, and then I'll give you 5 suggestions to start working on. So first, no, that's not me. I wish I had that kind of hair. I'm not sure I ever had that much hair, but the fiduciary obligation logos. So logos is Latin, which is an appeal to logic. So I want to appeal to your logic here today. One of the primary obligations of a responsible plan fiduciary is to determine the reasonableness of the fees incurred by participants in the plan in relation to services received by the plan. According to the Department of Labor, which is the overseeing body for most folks, if you're an ERISA plan, you are subject to the DOL. If you're not ERISA, you're probably subject to state fiduciary laws. And many of the Western states out here, at least the ones I work in, have state fiduciary laws or state trust laws that are written to reflect ERISA. So Department of Labor says, among other duties, fiduciaries have a responsibility to ensure that the services provided to their plan are necessary and that the cost of those services are reasonable. So if the Department of Labor is saying that, logic, logos, should dictate that it should matter to us, the plan fiduciaries. Pathos, so another Latin term. So pathos is an appeal to emotion. So here we have that standard chart that we've been seeing forever. 2 participants, Jim and Marcia, both had saved $2,000 a year for retirement. Both start saving at the age 25. Both save the same amount of money. They save they get the same investment return for the same number of years. The only difference is that Marcia pays 1% in total fees and Jim incurs 2%. And that difference, while it's only 1%, ends up having an effect of reducing Jim's account balance by 24%. That's a significant number. Now, you may be thinking, well, there's no way that we would have that difference of an expense. One of the clients that recently hired me had a 93 basis point, almost a full 1% difference in what they were paying before we got working on their plan and what they're paying now. So we literally almost hit the 1% by getting 0.93. Those participants will have a materially different future now that we've been able to reduce those expenses. And the last bit of our Latin today, ethos. So ethos is an appeal to ethics. So we have an ethical requirement to watch over the fees that we're paying, or the fees that we're making our participants pay. We just saw the effect of fees, so ethically speaking, we really should pay attention to what these fees are. But also, from a fee litigation perspective, and the next couple slides are going to be a little scary. So there are numerous cases targeting nonprofit and for-profit employers, and they continue to grow every day. As attorneys learn how to litigate ERISA, more and more attorneys will do so. Schlichter-Bogart laid out the blueprint, and now we're seeing other attorneys saying, hey, I can do that, and I can get paid for doing that. So we're seeing more and more more and more suits. Defendants include employers, the organization, as well as individual fiduciaries. Remember, if you're a fiduciary, this is a personal liability. So you as an individual person can get named in these suits. Class action attorneys are soliciting plaintiffs via advertisement. I'm not kidding, folks. Take a look at that URL. It's an actual advertisement for class action lawsuit against like 80 different schools. Or just Google ERISA fee lawsuit. It gets a little scary when you do take a look at these pieces. And suits include both the investment fees and the record-keeping fees. Usually people have said, well, we have to make sure that our plan pays reasonable fees. Well, the investments themselves have to pay reasonable fees. And we're going to get to that a little bit later in the presentation. So for private employers, those are some big numbers. We've seen them recently come down to $5 million plans. So just because you may be a smaller plan does not mean that you're exempt from this. There are attorneys that are going after small plans. And look at those attorney fees. That's why. And now that we have several cases that have been adjudicated and or settled, there are many junior attorneys that now have the blueprint to go out and sue plan sponsors. For the nonprofit world, this is all within probably the last year and a half. And I want to spend some time on this slide because on the right-hand side you can see the different well-enumerated claims. So if you're a for-profit employer, you only have one vendor, that's fine. The rest of these will also apply to you. But a lot of nonprofit employers have multiple record keepers, which result in higher fees. Think about economies of scale. If I've got 50 million with this vendor and 50 million with that vendor and 50 million with another, well, I don't quite have the economy of scale or the purchasing power of a $150 million plan. So there are fee incentives to consolidating record keepers, or at least document why you think multiple record keepers is worth the extra fee. Too many total investment options. This is one that I really want to see get adjudicated, because how do you determine what too many is? You know, we at Multnomah Group have an opinion on what the right number is, what the right number of asset classes are, depending on our client. But how do you determine what too many is? One of the arguments they're saying is, well, you're splitting up your asset base, and you're not going to be able to drive investment fees lower. And that's fair, but I really want to see what the courts have to say about that. Duplicative investment options. If you've got an annuity company, you probably have so many investments that have materially similar investment objectives that you're really not doing your participants any good. Revenue sharing arrangements that have led to excessive fees to service providers or kickbacks. We're going to define and talk about revenue sharing a little later in this presentation. And yeah, some of the record keepers do keep them. They disclose them, but they usually do keep them. Plans utilized by TIAA or TIA, the traditional annuity, which had severe restrictions and penalties for withdrawal. People are wondering if tying your money up for 9 years and a day is in the best interest of participants. And plans that utilize actively managed funds rather than passively managed funds with no performance benefit but higher fees? Interesting question there. Index funds with higher fees rather than a similar index fund with lower fees. I'm going to talk about share classes later. If you're talking about index funds, one fund is materially the same as another index fund if it has the same benchmark, but different companies charge different fees. If I can get one for 5 basis points, then why am I paying for a different one at 20? And those are real numbers that we commonly see. Retail share classes with higher fees were utilized when institutional share classes with lower fees were available. This was just adjudicated maybe a year and a half ago. Retail funds in a retirement plan where they were not controlling for costs. Having a higher fee product is not against the law if it is reasonable for what you're getting. You just have to document why you believe paying higher is appropriate. And with active managed funds, you may say we're getting more performance. But if it's the difference between a retail share class and an institutional share class, it's really hard to say we're paying extra fees for this reason and to be able to justify that reason. For record keeper services, plans did not engage in competitive bidding process for third-party service providers. You know, I hear people say every 3 to 5 years you should look out. Personally, I think that's a little too quick. And if you've ever made a record-keeping transition, you know it takes a year and a half, 2 years just to get comfortable with that new record keeper. And if you've ever done a search, you know it's a year, year and a half. So if you use kind of what a lot of people say, 3 to 5 years, that means you'd be constantly in flux, either looking for a new record keeper or getting comfortable with the existing record keeper. But what is prudent, that's going to be different for each person, but periodically, vendors really should at least do an RFP for a price check to see what's out there in the marketplace. And then options that have historically underperformed should have been removed from the plan. So not necessarily a fee complaint, but an investment quality complaint. But everything else in this list, these are all the grievances filed by plaintiffs' attorneys on a number of different plan sponsors. So I said we were going to get into the minutia of fee types, and we're going to. But first, let me start at the high level to kind of lay out how we see retirement plan fees. So that generally they can put into 3 main categories, but the associated services may apply to multiple categories. So let's walk through them. Generally, asset-based fees. Asset-based fees are calculated as a percentage of the plan assets and can be based on a portion or all of the plan. Often you'll see all variable products or all mutual funds will have an asset-based fee, but one of the proprietary general account products may not. It's usually fully disclosed. I say usually because if you're a governmental plan or a church plan or a non-ERISA plan, you may not be getting the 408B2 or the 404A participant fee disclosures, and it's going to be buried somewhere in your contract. And or some investment products don't have fees. Now, that's a very strange statement to make, but I'm going to explain it in just a couple slides. And then per participant fees are calculated based on the number of participants in the plan or eligible for the plan, and they're a hard dollar charge. So it may be $25 per participant, $50 per participant, $200 per participant who has a brokerage account. They're individual hard dollar fees for the individual person, does not vary based on plan size or assets that that participant has. And then there's itemized service fees. This is the one that a lot of my clients usually get caught up on. Itemized service fees are typically applied as a fixed charge for a specific service provided, such as a participant loan or hardship or non-discrimination testing. Many of my clients say, wait a minute, we're already paying them 20 basis points. Why are they charging me $2,500 for non-discrimination testing? And or if you make changes in your investments and the record keeper has to go through the process of generating all those notices and sending out all those letters, they'll often charge for a fund or a plan change. And then the fourth is another category, professional or other miscellaneous investment fees or contract fees, so consulting or auditor or legal. So these are the categories of the common fees that we see in retirement plans. Now I'm going to break them down a little bit. The first 3 slides here, we're going to talk about asset-based fees. So asset-based fees as they relate to investment products. So mutual funds, collective investments, commingled funds. If you're not familiar with a collective investment or commingled funds, think about it as a mutual fund that doesn't have all the public registration and public disclosure requirements that a registered mutual fund does. It's still a collective managed pool with an investment objective. So mutual funds have an expense ratio. All mutual funds do. Almost all collectives and commingles do. Depends on how you've put the product together. But they all have expense ratios. That expense ratio has 4 main components. So the investment management fee, that's what we're paying to the stock picker so that they can do their research and they can decide what companies that they want to buy. Administrative expenses, well, they have to have a computer and a desk, and they probably have first-class flights all over the country. And then there's trading expenses. If you've ever bought or sold a stock or bought or sold a house, you know that there are trading expenses. You pay fees, you pay commissions, you pay transaction fees. And if you've ever bought a stock, you know there's a difference between the price you buy and the price you sell it at, the bid-ask spread. So there's trading expenses embedded in mutual funds. And then there's revenue sharing. And I'm going to break that out a little bit further later. Revenue sharing simply is a component of the expense ratio, so it's fully legal, fully disclosed, and written into the prospectus, that gets paid to a third party. They share some of the revenue of the expense ratio with a third party, and I'll break that down in a little bit. But other asset-based fees for investment products, stable value accounts. Stable value accounts are kind of like a money market on steroids. They might be paying 1.5% or 2%, and they look and act like a money market. Well, they're going to have an expense ratio. So they have everything that we've listed above in expense ratios, but they're also going to have something called a market value adjustment. Now, this is a realized fee, as in it's something that your participants will pay if it gets used. A market value adjustment is when you say, okay, we want to fire you, stable value fund, and we want to hire a new stable value fund. However, if interest rates are higher today than when you bought the product, that means the bond values are lower. Stable values are materially comprised of short and intermediate term bonds, and as interest rates rise, bond values fall. So the current value of your stable value may only be 97 cents on the dollar because bond values have fallen because interest rates have risen. Well, if you say, give me all the money, they're going to have a contract provision that says, okay, subject to a market value adjustment. So you say, give me the money today, and they say it's only worth 97 cents on the dollar. Well, that's a 3% investment expense that's going to be incurred by your participants. Or you can wait 12 months, and they'll give you your money over time. So that's a market value adjustment. And then there's other asset-based fees for investment products, general account. If you've ever heard of just that broad guaranteed account, or the insurance company that you're working with has a guaranteed account where they're paying you a really good interest rate. General accounts or guaranteed investment contracts end up being the assets of the insurance company. You give them their money, the general account of the issuing insurer, they hold it, it becomes an asset of their organization, they pay you an interest rate, and they promise to pay you back your principal when you ask for it. However, because you're not investing in a product, you're really giving your money to an insurance company, there's no explicit fee. So earlier I said there are some products that don't have fees. How can that be? Well, a general account product has no explicit investment management fee, no administrative fees, no necessary trading expenses, no revenue sharing. I'm going to talk a little bit further about general account products in a minute, but they don't have those stated fees. They sound like they're free because there's no bill, there's no deduction, there's no percentage of assets that they keep. We'll get back into that in a minute. Here, we'll get back to that right now. The revenue made by that company, so you give your money to that insurance company, the revenue that they're making is based on the spread between what they pay you the crediting rate, and what they've earned. This is General Insurance Company 101. They pay you 2%, but on the money you've given them, they've earned 4%. So while you're getting 2, they're also getting 2. So there is that cost, that implicit expense, that they are earning money off of your money that they then get to keep. Nothing in life is free. Even if they're not sending you a bill or showing you an expense ratio, they're earning something off of your money. The question you have to ask is that a reasonable crediting rate? If we're getting paid 2% and we think they're making 4%, can we get 2.25% from somebody else, or can we get 2.5% from somebody else and narrow that spread? That's the way you look at fees with a general account. And again, if you have any questions, by all means, please submit them, and Lindsay will address them as we see them. So asset-based fees for investment products continued. Variable annuity contracts. So if you're a mid-size or smaller employer, you might in fact have a variable annuity contract. Those contracts have the underlying investment product fee, so the mutual funds that are in them, plus they have other charges on top of them. So they'll have an expense ratio for that product, but then they also will have some sort of a variable asset charge. And that's the way they may describe it in their contract. It may be described as a variable asset charge, a 1% fee, for argument's sake, a 1% fee on top of the investments. So if your investments come in at 0.25 and you have a 1% variable asset charge, your total fees are 1.25. They may also call it a mortality and expense fee. It might be called an insurance-related charge. But then there's also almost always, with variable annuity contracts, a surrender or transfer fee. They want to make sure that they're going to get paid when you say you want to leave. You have to look at your contract and find out what kind of surrender fees that are going to be in there. Very rarely do we ever take over a variable annuity contract and there's no surrender fees. In fact, one of my more recent ones had 4 contracts, 4 variable annuity contracts. All 4 had, well, 3 of the 4 had 7-year surrender charges, and the 4th one had a 9-year surrender charge. I'll go into surrender charges a little bit later, but you need to really read your contract and understand all the different fees that apply, because you don't necessarily see them. They're buried in the products.
Hey, Brian.
And then, yes?
We have a question if you want me to address it right now.
Sure.
The question is there a way to find out the administrative fee or the expense from the GIA?
No. The general account? No.
Yeah.
You can ask your record keeper what their spread is on that product, but generally they won't answer. Now, that may be because they don't want to, maybe because they don't know, but no, there really isn't. The best way to understand is to compare what your crediting rate is compared to what other GIAs will offer. If you're getting 2, but you're getting others that are offering 2.25 and 2.5, well, there's your answer. Sorry, I wish I had a very concise answer to that, but that's the truth is there is no way to tell. You can only compare what you're getting. Thank you for that. Wrap fees are a catch-all fee. Wrap fees tend to be through independent TPAs, and it's a general fee that goes on top of all the assets, all the moving parts, and they're going to pay for record keeping, it's going to pay for custody, it's going to pay for admin testing, 5,500, employee communications, you name it, it's all going to be wrapped up in a wrap fee. Wrap fees are common with smaller and mid-size plans, and wrap fees are becoming more and more common every day. So some of you may have heard the concepts of fee levelization. Fee levelization is where everyone pays the same rate, and you do that through a wrap fee. So that revenue sharing that we talked about a little earlier, and we'll talk about later, comes from the mutual funds, and they go back to the plan, and then everybody pays the same wrap fee on top of those investments. We'll talk about revenue sharing a little bit later. Oh, look at this, revenue sharing. So the asset-based fees, revenue sharing. So revenue sharing is included in the investment product expense ratio. Let me be clear about that. This is not a shell game. It looks and feels like a shell game, but it's not. It's written in the legal document, the prospectus. It's fully disclosed. It goes back to the concept of mutual funds versus collectives. Mutual funds have public disclosures. Revenue sharings are a public disclosure. It's available in the prospectus. You can find it online. It's a legally required disclosure. So revenue sharings can consist of 12B1 fees, which is what people hear a lot, shareholder servicing fees, sub-transfer agency fees, and I'll stop right there for a second. So 12B1 shareholders and sub-transfer agent fees, they're all very similar, as in they might be 0.1, 0.2, 0.25 of a percent, and that's going to be part of the expense ratio, not additive to. My favorite definition is shareholder servicing, because let's just take a fund example and a record keeping example. Your record keeper is ABC Record Keeper, and you've got the Z mutual fund. Well, that Z mutual fund may have 0.25 of shareholder servicing, but that Z mutual fund doesn't work for ABC Record Keeper. But the record keeper is providing shareholder services, right? If I'm invested with that record keeper, they're giving me account statements, maybe doing education, doing all kinds of compliance testing. That mutual fund doesn't have to service its shareholders. So it will pay a shareholder servicing fee to the record keeper to service me. That's the most communicative definition that I understand for revenue sharing. Fully legal, fully above board, goes from the mutual fund to the record keeper to pay for those services. These are superfluous. They're almost everywhere in almost all funds, in almost all fund companies. You really need to stop and understand revenue sharing, because while I said it's not a shell game because it's fully legally disclosed, it kind of is a shell game because it's never really shown, never really understood. So I encourage you to understand the revenue sharing that's being paid by your investments and who they're being paid to. That may be disclosed in your 408B2, it may be disclosed in your 404A, but you really need to understand these. So services kind of, yes?
We have a question about wrap fees.
Yeah.
The question is, are wrap fees a good approach for a non-ERISA plan?
They're a fine approach for ERISA or non-ERISA plan. The reason I like wrap fees is it's the same percentage on all plan participants. So everybody pays the same rate. The difference between a wrap fee and another way to pay record keepers would be revenue sharing. And what I didn't get into with revenue sharing is some funds may have 0, some funds may have 0.2, some funds may have 0.5. So the rate that your investors pay can be materially different depending on what investment they chose. I may pay 0 because I'm in that 0 revenue sharing fund, but you may be paying 0.5 and shouldering the majority of the cost for this plan because of the fund you chose. Asset-based fees, generally speaking, allow that revenue sharing to be given back to the participants. So if I paid 0.5, I get 0.5 back. And then that asset-based fee is going to be the same rate for everybody in the plan, so that no matter what investment you chose, your fees are going to be the same. That's my opinion on why I like asset-based fees, but you do have to account for the revenue sharing. Thank you for that. So these fees, revenue sharing, they go to pay for things like record keeping, administration, compliance, education. That's kind of what I said. The shareholder servicing fees go to the record keeper to service a shareholder. Now, there are 2 bullet points I didn't touch. At the top end, revenue sharing includes commissions, front-end load commissions, or surrender charges. They go to pay the broker. The person that's working on your plan, the person that brought you the plan, tends to be on the smaller side, like sub $1 million plans. But commissions can and will be paid to brokers or selling agents. They also can be surrender charges, which may be beneficial to the shareholder or may not. And I'm going to talk about that in a minute. Surrender charges can be at the record keeper plan level, meaning it applies to everybody, or it could be on that one individual fund, such as a small cap or an international. And where they do that, what they're trying to do is limit trading. They will say to you, you will have a 2% surrender charge if you sell this fund within 60 days. Late trading frequent trading expenses, the funds that are small caps or internationals tend to have these frequent trading features where if you do sell that fund within 60 days of buying it, you'll pay a 2% surrender. We'll talk about that a little bit further in a moment. The third main type of fees are per participant fees. And that vernacular is exactly that. It is per participant. It's not at the plan level, it is at the individual participant level. Per participant fees are calculated based on the number of participants in the plan or eligible for the plan, or are a fee for specific participant-initiated events. Typically, they're charged to the participant for individual services for that participant, or to the plan sponsor for services performed at the plan level. Services may include a quadro, qualified domestic relationship order. When you get divorced, you may get a legal order that says you need to share your account balance. That legal order needs to be reviewed. There will be a charge to the participant for reviewing that quadro. Participant statements. You may have that $20 per participant for all participants because they're going to get participant statements. They're going to get education and enrollment services, administrative services, technology access, or call center availability. So in smaller plans, meaning 10 million and below, you may see a combination of fees. You may say, okay, we're going to charge 0.5% as a wrap fee or an asset-based fee, and $20 per participant. So every single person is going to pay the 20 and a wrap fee. But per participant fees, generally speaking, are for a specific service initiated by the participant or a specific service initiated by the plan sponsor whose fee is based on how many participants there are. And then itemized service fees. I know this is fascinating, right, folks? Itemized servicing fees are generally charged on an as-incurred basis and may be paid by the plan sponsor or by the plan or by the participant. These are fees for specific services detailed in the vendor services agreement, deep in the agreement. Some itemized service fees are per participant, such as a loan. If you're going to take a loan, there's probably going to be a loan initiation fee of $50 or $75 and a loan administration fee of maybe $5 or $10 per month. Distributions. Somebody has to process that paperwork. Somebody has to issue the 1099. Distributions are going to have a fee. It might be $25, it might be $50 or $75 per distribution. These are charged to the participant, not to the plan, not to the plan sponsor. They're absorbed by the individual participant who initiated that action. Then, some itemized service fees are plan-based. Fees charged for a specific service to the plan, such as non-discrimination testing. If you're an ERISA plan, you have to make sure you're abiding by the non-discrimination rules. If you're not an ERISA plan, you still have to make sure you're abiding by the IRS individual limits. You know, that $18,000 or $24,000 rule? Those are IRS. Even if you're a governmental employer, church, non-ERISA, you're still subject to that. You still need to stop and do that test. Now, that test is simple. You can do it internally in HR or payroll, but some people outsource it, and it is a form of non-discrimination testing. Form 5500 prep. Fund changes. So for Form 5500s, you may end up paying $2,000 a year to have that 5500 done. You may pay another $2,000 a year for the non-discrimination testing. Read your contracts. It may or may not be an itemized fee. It may be wrapped up in that asset-based fee or the wrap fee, but read your contracts. And this is the one that's becoming more and more prevalent is fund changes. Over the years, I've seen more and more of the record keepers say, hey, you need to make that fund change. Okay, that's fine, but now we have to update our systems. We have to design a communication letter. We have to mail and post all these letters. We're going to get phone calls we have to service. So we're going to charge a fund change fee. And it could be anywhere from $1,000, which is on the very low end, to $3,000, $4,000, $5,000, depending on how many participants you have and how many letters need to be sent out. So these are itemized service fees. They generally are not recurring fees. They're fees that happen for a reason and have a fee directly associated with the service. And then there's always other. There's always another category. The fees discussed so far are the most common types of fees paid for ongoing services provided to the retirement plans. These other fees are fees that might be charged and are typically detailed deep in the service agreement or in the prospectus, but they need to be understood. Sales charges. As I mentioned before, smaller clients, smaller plans, they'll have a broker who might get paid 4 or 5% on each contribution going into the plan. You need to understand that because it makes a material difference in the amount of money you have to invest. And what are you getting for, this is the important part, what are you getting for those fees? What service are you getting for that surrender, for that finder's fee, for that commission? Is it in the best interest of the participants? Contingent deferred sales charges, contingent upon you firing the record keeper. Unfortunately, many clients don't realize that they have a CDSC, a contingent deferred sales charge, until they decide to leave that product or that record keeper. And then they find out that they have a 5-year notice period where you have to give them a 5 years advance notice, or they're going to start deducting fees from your plan. I would strongly encourage everybody the next time you look at your fees to make sure you understand your contingent deferred sales charges. Exchange fees and early redemption fees. So these exchange fees typically are in less liquid asset classes. Exchange or early redemption fees are designed to limit short-term trading in the fund. So you all might remember 12, 13 years ago, there was, Putnam got themselves in a lot of trouble because they were allowing investors to watch the European close and then trade before the US market closed, and vice versa. So they were moving money in and out on a daily basis. Now, that's good for the person who's reaping that benefit, but the rest of the participants in that fund, the rest of the investors, are paying all those transaction costs. All that money outflow is hurting their returns. So an early redemption fee is charged by the fund to an investor as a redemption expense when the investor sells out of a fund after a short period, 60 to 90 days. That 2% doesn't go to a broker, doesn't go to the investment company. It goes back into the fund to help offset the expenses for the other employees. It's really quite cool if you think about that for a moment. If you're a participant and you're investing in this fund and there's a rapid trader in that fund, they're going to make you whole by paying these 2% surrender charges. As I say there in the third bullet point, paid back into the fund to compensate the fund for the cost of the investor's short-term trading activity. The SEC generally limits redemption fees, again, the fee where we're putting it back into the fund, to 2% for mutual funds. But insurance contracts, when we talk about contingent deferred sales charges, they can be as high as 9%. Like I said earlier today, one of my clients had one of those, 3 7-year contracts and a 3 7-year surrender charges and a 9-year surrender charge. If you're working with an insurance company, I encourage you to go figure out if there are any contingent deferred sales charges in your plan. Other continues, market value adjustment. So we talked about this a little bit earlier. It's not a stated number. You can't say what's the expense for the market value adjustment. It's a cost that's incurred to liquidate an investment, typically bonds, earlier than was initially anticipated or agreed to. It's found in investment products where liquidity is limited and is dependent on the market environment at the time liquidation is requested. So stable value and GIC products are also there. If interest rates in the market are higher than when the investor initially purchased the investment, the adjustment may cause your redemption value to be lower. So a quick review here. If I'm invested in a stable value or a GIC, and those products have primarily bonds, and they might have bonds that are short and intermediate. And when interest rates go up, kind of like we've been in for the last year and a half, bond values fall. It's the metric of valuation. So as interest rates rise, if I decide I want to get out of that stable value from that company, those bond values that the company's holding may have dropped to 97 or 96 cents on the dollar. Well, they're not going to let me out penalty-free. They're going to say, sure, you can have your money with a market value adjustment. So you may only get 96 or 97 cents. Or they say there's a put on your redemption. And that can be anywhere from 12 months to 10 years. So often with stable values, you'll see a 12 to 24-month put, meaning you give them notice, 12 months later or 24 months later, they'll send you over your entire portfolio. The reason being, they have to give those bonds that have had a loss due to interest rate rises, they have to give those bonds a chance to recoup their value so that the fund company doesn't have a loss because you chose to leave your money. Then you'll also see with certain record keepers, certain investment managers, where you may have a 5-year put. So we'll give you your money 20% a year over the next 5 years. Or even 10 years we've seen. We'll give you your money 10% a year over the next 10 years. Unfortunately, those 5s and 10s, those really hurt. And so many clients don't ever know that they're in them until they try to get out of them. And they're common. They are not few and far between. They are common to have 12 to 10 years in the fixed income market. I encourage you, if you have one of those weird products, a general account, a stable value, a GIC product, any of those unique fixed income products, understand the liquidity provisions, because that's where they try to put these pieces on to protect the fund company.
Hey, Brian, we have a question.
Yeah.
This participant says, we have a wrap fee and a third-party advisor fee, both of which are based upon AUM. Is there a published report available to compare our fees to other funds with similar numbers of participants and AUM?
You clicked out on me for a second there. Let me repeat what I think I heard. They have an asset-based fee for their plan, and then they have an advisor's fees as well. Is there a place to get a benchmarking number?
Yeah, is there a published report available to compare our fees to the other funds in a similar number?
Yeah, you can go to plansponsor.com or planadvisor.com, and you can get broad numbers. They're not going to say, hey, you've got between 500 and 600 employees, and this is what your fee should be. But if you look at plansponsor.com or planadvisor.com, they do studies, and they will report larger universes of fees. And what I mean by that is they'll say plans between 1 million and 5, or plans between 5 and 25 million. So they'll give you broad numbers, but not very specific. But you can start there, or you can email me and we can have a separate conversation. Multnombre Group does an annual fee benchmarking study of record keepers, and I might be able to give you some better information. So in addition to looking for third-party benchmarking services, 5 things for you to consider now. So please, please, please review your vendor's 408B2 fee disclosure notice. If you have an advisor, talk with them. If not, work with whoever your relationship manager is or client services manager, because by law they have to disclose all the fees that they can charge you and the services that go with those fees. So condense this presentation into a 6-page document that says, here are the services, here are the fees. But you probably will need help, so please work with your service provider or your advisor to take a look at it. Now, the beautiful thing about a 408B2 is it's pretty much written in English. There's a little bit of technical in there, but it's not a legal prospectus document written by lawyers. It's not a highly technical document. 408B2 disclosures can be read by most people that work with retirement plans. Benchmark your vendor's fees, kind of like the last question. There are benchmarking services out there. There are broad scope benchmarks out there, maybe too general for you. But if you've never benchmarked your plan services, I strongly encourage you to. The fee differences between somebody that monitors their fees and somebody that does not monitor their fees is extraordinary, in my opinion. Negotiate a better fee structure. We talked about revenue sharing being inequitable before. So for example, let's just say I'm at the Vanguard fund. Vanguard doesn't pay revenue sharing. I am not paying for the record keeping services, but somebody else invested in a different mutual fund that pays revenue sharing may be paying an undue amount, a higher rate than you are, and it may not be fair. When we look at these, I will commonly see revenue sharing from 0 up to maybe 0.45. I very rarely see revenue sharing above that, but you're paying 0, but the person sitting right next to you may be paying 0.45. So if you go back to fee levelization, looking at wrap fees, looking at asset-based fees, what you can do is negotiate a better structure where if that fund pays 0.45, then 0.45 goes back to the investor. You took it from me, give it back to me on a monthly or quarterly basis. That way I'm neutral, and then charge me an asset-based fee or a rep fee so that everybody pays the same rate. Conversely, per head fees, so let's just say we didn't have any asset-based fees and we were giving the revenue sharing back to the participants. Well, the record keeper is going to want to charge per head fees. It may be $5,000 a year plus $75 per participant. Well, if you're a startup lower earner and somebody wants to charge you $75 a year, and you see, let's make it $80 a year just for ease of math, and you see that $20 deduction on your statement each quarter, and you're just getting started, that can make people stop and say, I can't afford to do this. So you have to be aware of how it affects your lower earners. And then consider fee levelization. If you haven't considered fee levelization, please do. The same rate gets charged to all participants. It's the most equitable way that I have found in this industry to assess retirement plan fees. All your record keepers, all your service providers will understand fee levelization. Give them a call and say, hey, I'd like to talk about implementing fee levelization in our plan, and then let them drive. But fee levelization is, in my opinion, the most equitable way to assess fees in the retirement industry. Review availability of lower cost share classes of the same investment. Earlier I had said about a year and a half ago, it was actually Tibble versus Edison, that case was settled, and they had a retail investment fund in a retirement plan whose fees are significantly higher. The same exact product was available for lower fees, but they never did anything about it. Now, that's a little bit obscure because it's this case law that I'm talking about, and we don't know anything about that. But look inside your own plan. Are there lower cost funds available? As your assets increase, you may qualify for lower cost share classes. I'll give you an example of what I mean. If you have $3,000 and you want to invest in the Vanguard 500 index, they're going to charge you 0.2 basis points. If you've got $2 million, that fee drops down to about 0.15. If you've got $20 million, that fee drops down to about 8. If you've got $100 million, it drops down to about 5, and if you've got $200 million, it drops down to about 2. It's all the same investment product. The only question is, do you have the lowest cost share class that you qualify for? And what I'll say is, I find each year when I do this for my clients, usually there's one fund. There's usually a fund each year where either they've reduced their minimum, such as Cohen and Steers about 3 or 4 months ago, they waived their minimum for their institutional clients. I was able to reduce the investment expense for many of my clients by about 0.24%. just by trading down the same share class of the same product. So the fund companies may change their minimums, but you also may have aggregated enough assets over the years, especially since we're in a 9-year bull market, that you now have reached the new milestone and you now qualify for the lower cost share class. I also encourage you, when you talk about fee levelization, to talk about share classes because it's free money. It doesn't cost you anything, doesn't cost the participants anything, it just reduces expenses. And document, document, document your prudent process. Whatever you're doing, put it in a file. As the DOL says, if you didn't put it in writing, you didn't do it. I don't mean you have to sit down someday and write a 10-page thesis on what you did and why you did it. Get your reports, put them together, put a note together as to why you made the decision you did. Put that in your fiduciary file. With that said, this comes to the end of my presentation, but there are 2 more papers that we've written. The bottom one there, fee models. So when we talk about revenue sharing, we talk about asset-based fee, I actually take a much deeper look into the different fee models that exist out there. You heard me say a small plan or a mid plan or a large plan. Yeah, there's different models for them. And I explain the different models in that paper. And then the first paper there, A Guide to Retirement Plan Fees and Expenses, that would be a 5-hour presentation. So if you want to know more about the stable value investments, you want to know more about how they assess their fees, how they earn their fees, I detail it in ad nauseum, real depth with the Guide to Retirement Plan Fees and Expenses. Hey, Lindsay, that's about all I have. Are there any other questions or anything else we can address?
We do. We have a couple of questions coming in right now. So the first one is, what do you think if plan sponsors and the plan invest in the same funds, example CCTs and LPs, and they get a lower fee expense because combined the asset under management are higher.
Okay, so who gets the lower fee is the question. So I'm going to assume it's ERISA, and I'm going to make a potentially negative assumption here, and I'm going to assume that the plan sponsor is receiving the fee benefit. That's probably a prohibited transaction, and here's why. You as an independent organization may not benefit from the retirement plan. If you're outsourcing your asset management to somebody and they're also managing the retirement plan, and they say, we're going to give your company a lower rate because we're managing these millions of dollars in your retirement plan, you've just benefited from the plan assets. So I would encourage you actually to have a conversation with an ERISA attorney and find out if that is a prohibited transaction. If it's the other way around and the retirement plan is inuring the benefit because the plan sponsor is paying the higher fee, there's no problem there. But if you're getting a discount because of the retirement plan, I encourage you to talk to an ERISA attorney. Sorry, I know it's not what you wanted to hear, but that's my thought.
Okay. We have a couple other questions. What do you consider a small, mid-sized plan?
Oh, that's a great question. What I consider and then what the benchmarking services consider, they're all very different. So small plans tend to be, 5 to 25 million. Some people will say 1 to 5. Some people will say 1 to 10. So the question is do they also have a micro market? Micro markets are $1 million and under or $5 million and under. So loosely, 5 to 25 million would be small. Mid would be 25 million to maybe 100 million, 150 million, and large is above that. But again, it depends on who you're asking. I would say small is under 10 million. To me, mid would be 25 to 150.
A follow-up to that from the same participant, will they ever have a chart for levelization?
Will they ever have a chart for levelization? I'm not sure I understand that question, but let me guess, and if you want to retype it, that's fine. A chart for levelization. So I hear two questions there. If you were to institute fee levelization and have to address that revenue sharing component question, yes, the record keeper can build a one-pager that says you'll be charged this asset-based fee, and each individual fund that has these revenue sharing components, and it'll list it out, will be credited back to you. So it'll show you at the top of the page, hey, you're going to pay 0.5, and then the bottom half of the page will have all the funds with the revenue sharing listed out next to them credited back to the participants. I don't know if that was the question. If that wasn't the question, please re-ask it or email me directly.
Well, it looks like Marilyn has come back and said fees going down because you are a larger plan getting institutional fees.
Fee is going, yeah, so if you're paying through revenue sharing, those numbers are fixed from the investment company. You have to negotiate with the record keeper how much of that they get to keep, how much of that they should return. But yes, as fees rise, if you use an asset-based fee, it's much easier to say, let's go from 20 to 19 to 18 to 17, rather than try to play the shell game of, well, let's use this mutual fund because it has a lower share class.
We have a follow-up to the very first question about the plan sponsor and the plan investing in the same funds.
Yes.
Abby is asking, what if both the plan and the plan sponsor get the benefit?
Well, I think that's okay then, because the plan sponsor is not necessarily benefiting at the cost of the plan. And that's the difference, is you can't benefit at the cost of or at the because of the plan. If you have both your fees are lower but the same, then I don't see an issue. Where I do see an issue is if they're giving you a discount to manage your plan sponsor's money because they have your retirement money. But if they're both the same, good for you.
That's all the questions we have right now, but we still do have a couple more minutes if anybody else wants to throw a question out for Brian. We can give it a couple minutes here.
Sure. And if I didn't answer your question directly because I didn't understand the question, feel free to email me and we can dialogue about it.
Let's see. We do have one more question. I can answer this question. Are we going to email your slide presentation? Yes, there will be a follow-up email going out either later today or first thing tomorrow that will include the recording from this webinar as well as Brian's slides.
All right, hearing nothing else, Lindsay, sounds like a wrap.
All right, sounds good. Thanks everybody for joining.
Thank you all for your time today. Have a great day.
Bye.